Welcome back. You're watching us here on Chartbusters. Let's talk about Tega Industries. Now, the stock over the last 12 months or so has doubled from 450 odd to a little over 900. And in yesterday's trading session itself, it was a big mover up in double digits, closer to 20% as well. And that on account of a strong set of performance coming in from the company. In fact, their margins expanded over 200 basis points. There was an over 50% growth that we saw in their profits as well. And they completed the acquisition of McNally Engineering at the cost of 165 crore rupees. Mehul Mohanka, who is the MD and CEO of the company, joins us to detail all this and more. Mehul, thank you for joining in and congratulations on a good set of numbers. Just wanted to know, last year you did about 16 to 17% sort of volume growth with 5-6% price hikes. Is that likely to continue in this year as well? And your margin expansion, which came close to 26% in the fourth quarter, is that likely to continue into FY24 as well?
Morning. So the volume and price growth, I think, is something that's going to continue to track into the next couple of years as well. We've been delivering quite significant growth in our conventional spares business, and McNally acquisition is just going to add on top of that. I would just like to caution the markets a bit in terms of the last quarter had some consolidation effect of McNally's numbers into our overall numbers, and we did capture some of the best portion of the last 5 weeks of consolidation into our numbers. So that did show a positive uptake on the overall numbers, but McNally's numbers as it shows is not truly sustainable over the next year or two.
Got it. All right. Hi, Mehul. Good morning and congratulations on a good set of numbers. Mehul, on this base of around 1,200 crores, you're saying you'll grow by around 15 to 20%. Should we work with that number?
Yes, we've always been, guiding the market around 15% CAGR, and I think that's something that we're going to continue to deliver. We did have a phenomenal quarter where we went up to 24%, but we've always been a conservative company from a guidance perspective.
Okay, all right. So around 1,400 crores, I guess, is a fair estimate to work with, going by the numbers that you're telling us. And in terms of margins, you're clearly telling us that this 26% appears to be a bit of an aberration, because the asset that you've acquired from McNally as well, the equipment out there, which is not such a high margin business, but it could ramp up from year on. So give and take everything, what kind of a margin outlook should we work with? In the past, you've spoken about early 20s. Should we continue with that kind of a margin number?
So Tega will continue to, on a consolidated standalone basis, deliver close to 21 to 22%, and McNally, I think, will be in the early teens from a margin perspective.
Okay, and just one more number I wanted. Out of this 1,400 crores, how much will equipment sales be? Because that's a little margin dilutive, right?
Yeah, so McNally itself will also grow at about 15% year on year. Okay. In the first few years, and then I think it's going to significantly ramp up.
Right. You said that the numbers that you saw this time around, you wouldn't sustain them because of McNally. You captured the best parts of McNally. The last time you had joined us, you said that this acquisition could aid your revenues by about 5%. Over the next few years, it could be up to 15 to 20% of your overall mix. Just wanted to understand, what is the potential, peak potential of McNally? What sort of investment are you looking to make into that? And what's a sustainable margin profile for McNally?
So on the margin piece, that's the easier one. I think over the next year or two, I think margins will be at about sub 15%. Tega has a higher profile, as I mentioned, because of just the way the business is set up. And McNally will continue to deliver, I think, like I said, anywhere north of 15% CAGR year on year as we continue to fix the business. Of course, it's still early days for us. It's just been 2.5, 3 months since we've acquired the business. We're still learning, the business, and but we remain very positive in terms of delivering, value accretive growth. As far as this acquisition is concerned.
All right, Mehul, since the markets are so hot on your stock, and the numbers as well are delivering, you have to bring down your stake, right, by around 4%. Do you think the time is right, or will you like to wait for a longer duration and maybe get a better price as well?
So we have till December 24 as per regulation to dilute, and we will do that at some point. The business clearly does not require cash, as you can see on our balance sheet. So, but in keeping, with the spirit of the regulation, yes, we would need to dilute, and we will do so at some point when it's appropriate. But we're in no rush as of today.
No rush. December 2024 is what you have. I mean, last time you joined us, you also said that, FY24 may be a bit of a spent year when it comes to capex and capacity utilization is ramping up. Your Chile capacity is increasing as well. So FY25, let's talk about that. What is the revenue profile of the company look like then? What is the incremental capacity that comes on board? And Dynaprime, you were looking at almost 700-800 crores revenue in this year, FY24. What's the target there?
So when we'd earlier guided 800 crores, that was on the total mill lining business. And for us, mill lining remains 75% of our total revenue from a Tega perspective, with non-mill lining at about 25%. So that continues to hold. The Chile expansion continues to progress well. We've acquired land. We're just waiting for final approvals to start construction. And as we mentioned earlier, by early 25 is when we anticipate going into commercial production. So that will significantly add to our Dynaprime capacity.
You want to give us a number? What kind of potential revenue can things look like by 2025? And more importantly, Dynaprime. Give us that number. I think it was 25% of the business. And you said going ahead, it'll constitute 35% of the business. Now, that's what the street is very excited about. Tell us.
So that will happen. It's just that, we've taken a view from strategic purposes not to really share too much on Dynaprime. What I can only say is that the business is tracking really well for us, and Dynaprime continues to be a strong driver for the Tega business, and it will augment well with the whole synergy around McNally Synergy as well.
So as of now, what is it? It's 30% of business?
30 and slightly more.
Slightly more than that. So, we are working with around 360 to 380 crores, approximately going by what you did in the last year. Is that a fair? No, actually, it'll be 30% of the 800 crores, I think. So it'll be around 240 to 50 crores.
It'll be a bit north of that.
Okay, so it's 30% of the overall business. We get that 350, 360.
That's as much as you can get out of me this morning.
Right. The non-mill business was also margin accretive, right? The last time you said that the non-mill business has almost 400 to 500 basis points higher margins. You're not looking to strategically increase proportion from the non-mill business?
Yeah, so in terms of volume growth, non-mill lining business has delivered strong numbers for us in the last financial year as of March 23. And the margin expansion also to a large extent has come from the non-mill business. And we had put in place certain strategies to grow that business, not only in India, but globally. And that continues to play out well for us. And we will see really strong momentum coming in from that in the next 4 to 6 quarters.
Okay. All right. Final question then, Mehul, before we let you go, give us an idea about the working capital days. What is it? If you could give us an update over there. And also you paid out dividend. Have you got a dividend policy in place now? So
we do have a dividend policy in place. We've had that right from the start. And we have paid out 20%, which is 2 rupees a share of dividend, of course, subject to approval of the shareholders at the AGM.
Working capital.
Working capital is at about 148 days as of today.
You said that sustainable is close to around 130, 135. Would you bring it down?
Yeah. So our internal estimates are to bring it down to about 115 to 120 days. But because we have the fourth quarter effect where our revenues were on the higher side. So that's the effect of the expansion of the working capital cycle.
All right. Take a point, Mehul. Thank you so much for joining in, giving us all those details. The street liked your numbers. The stock market has rewarded your share price as well. But you're saying that you are in no hurry to offload your stake just yet because some growth drivers are ahead as well. 15% plus revenue growth with margins between 21 to 22% for the entity of Tega. With that, we'll step into a short break. Come back, get you more on the stock markets and individual stocks, actually.